Did you know that nearly 70% of millionaires in America don't have a college degree? Shocking, right? While many believe that a diploma is the key to success, the truth is that most wealth is built through smart investing, not formal education. In fact, studies show that over 90% of self-made millionaires invest in stocks and real estate. This video will reveal why relying on a degree alone won't make you rich. Instead, we'll explore the world of value investing, an approach that focuses on finding great companies at bargain prices. You'll discover strategies to spot hidden opportunities and understand how to build lasting wealth without breaking the bank. Are you ready to learn how to think like a millionaire? We'll dive into the secrets of the most successful investors and show you how to use those insights to grow your own financial future. Get ready to transform your mindset and your bank account. Chapter 1. Degrees versus dollars. The real wealth equation. Many people think a degree is the surest path to wealth. But here's the hard truth: your degree doesn't guarantee financial freedom. In fact, data from the Bureau of Labor Statistics shows that only about 16% of millionaires have a master's degree or higher. Sure, a degree might help you secure a steady income. But wealth? That's a whole different ballgame. Let's look at investing as an alternative. Value investing, in particular, focuses on buying assets below their intrinsic value. It's about finding undervalued gems. Legendary investor Benjamin Graham, the father of value investing, once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." In simple terms, he's saying that the true value of a business eventually shines through, even if others don't see it right away. Now, compare this to having a degree. A degree can give you a boost in your career, but it usually comes with a cap. Value investing, on the other hand, allows for almost limitless growth if you know where to look and when to act. It's no wonder Warren Buffett, one of Graham's best-known students, became one of the richest people in the world by focusing on value, not by relying on a fancy title or diploma. Statistics back this up. The average U.S. household has $41,600 in savings. Yet, those who invest wisely have more than triple that amount in net worth. And while only 10% of Americans own individual stocks, those who do often outperform those who stick to regular savings accounts. Value investing gives you a way to build wealth over time without needing an advanced degree. Chapter 2. The Millionaire Mindset Shift. Seeing value where others don't. Creating wealth isn't just about knowledge, it's about mindset. The key to value investing is seeing potential where others see risk. Howard Marks, a renowned investor, says, "You can't do the same things others do and expect to outperform." In other words, you must be willing to see what others don't. Value investors train their minds to look for hidden opportunities. Take the example of Apple in the late 1990s. While most investors ignored it, a few visionary investors saw potential. Their investments multiplied as Apple became one of the most valuable companies in the world. It's about developing what I like to call a value lens. To do this, start with curiosity. Don't just follow popular opinion. Look for companies that have strong fundamentals but may be facing temporary challenges. This is where many investors back out, but value investors step in. They realize that short-term setbacks don't change the company's long-term potential. Statistics tell us that 85% of Americans don't invest in individual stocks. Most people simply don't take the time to look deeper. They don't see the value, or they're afraid of risk. But the small percentage who do, they often reap huge rewards over time. Investing in undervalued assets requires patience, too. Research shows that successful investors hold onto their investments for 5 to 10 years on average. They know the power of letting value build over time. This isn't a get-rich-quick strategy. It's about letting your investments grow with the right perspective. Chapter 3. Timing is your secret weapon. Patience versus panic. Timing is everything in value investing. The best investors know that you have to wait for the right moment to buy, and the right moment to sell. In the stock market, Warren Buffett's strategy is famously simple. Be fearful when others are greedy and greedy when others are fearful. Let's break that down. When everyone else is excited and buying up stocks, the price often goes up beyond the true value. But when people panic and start selling, prices drop, even if the company's value hasn't changed. That's when a smart value investor steps in to buy. It's a strategy that goes against human nature, which is why it works so well. This patience is why value investors often do better in the long run. In fact, studies show that investors who time the market by constantly buying and selling miss out on average returns of about 4% per year compared to those who hold steady. It's proof that patience can pay off, especially when everyone else is reacting to short-term trends. Take the 2008 financial crisis. During that time, stocks dropped significantly. But value investors who stayed calm and bought solid companies at bargain prices saw massive returns in the following years. This doesn't mean you should rush to buy during every downturn. It means learning to recognize when prices are lower than true value. One way to identify these moments is by following market cycles. The stock market has patterns, ups and downs that repeat over time. Successful investors learn to spot these cycles and act accordingly. It's like surfing. The best time to catch a wave is not when it's cresting, but just before it builds momentum. Value investing takes guts. It's about ignoring the panic and waiting for prices to reflect actual value, which takes time. In the end, timing and patience are more valuable than any degree. If you're finding this information valuable, don't forget to subscribe. Join our community for more insights on building wealth through smart investing. Chapter 4. Moats and Margins. The art of finding unshakable investments. When you invest, you want to know your money is safe. One way to do that is by finding companies with strong moats. A moat, a term coined by Warren Buffett, is a company's competitive advantage that keeps competitors at bay. Think of it as the protection around a castle. It's what keeps a business strong even when times get tough. Take Coca-Cola, for example. It's not just a soda, it's a brand people trust and love worldwide. That's a moat. It means that even if a new soda company pops up, it's tough to take down Coca-Cola. Buffett explains, the most important thing in evaluating a company is to figure out how big the moat is around it. He believes in buying companies with durable advantages, ones that can hold their ground in any economy. Why does this matter to investors? Because companies with strong moats are often better at weathering economic storms. Data shows that companies with wide moats, like Apple, Microsoft, and Visa, tend to outperform the market by about 1.5% per year on average. This may not sound like much, but over time, it adds up to a significant difference. So, how can you spot a moat? Look at a company's market share, brand strength, and profit margins. Companies with high profit margins often have a competitive edge, allowing them to invest more back into their business. Another sign is customer loyalty. For instance, people don't just buy iPhones, they stick with Apple because of its ecosystem of products. Another interesting moat is switching costs. This is when it's hard or costly for customers to switch to a competitor. Microsoft Office is a great example. Once companies adopt it, it's difficult to change software because of training, compatibility, and data migration. This keeps Microsoft strong in the market. Chapter 5. Reading between the lines. Uncovering hidden gems in financial statements. Financial statements might look like a foreign language at first, but they're full of clues. Understanding them can help you spot undervalued companies. Here's a tip. Focus on cash flow. Unlike earnings, which can be adjusted or manipulated, cash flow shows the real money coming in and out of a business. A positive cash flow is usually a good sign. Look at Warren Buffett's advice on this. He once said, "I'd rather buy a wonderful company at a fair price than a fair company at a wonderful price." What he means is that the quality of a company is more important than its price. And financial statements help you judge that quality. One metric to check is the debt-to-equity ratio. A high ratio might mean a company is over-leveraged, meaning it has too much debt compared to its assets. In tough times, these companies can struggle. By contrast, companies with low debt are often better able to survive downturns. They don't have to spend as much on interest payments, freeing up cash for growth. Another key number is the gross margin, which shows how much a company keeps as profit after covering production costs. High gross margins often indicate a competitive advantage. For instance, software companies like Adobe have gross margins above 80%, which shows they can keep more of each dollar they earn. A final but important detail is to look at the company's free cash flow. Free cash flow is the money left over after a company pays its expenses and investments. It's a strong indicator of financial health. According to a study by MSCI, companies with strong free cash flow tend to outperform their peers by about 2% each year. This extra cash can fund dividends, buybacks, or expansion. If you enjoyed this video and want to learn more about smart investing strategies, subscribe for more insights and tips on building your financial future.